Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Monday, June 7th, 2021. What I want to do in this video is an update on the equity markets, followed by just a few trade ideas. Really, I'm struggling to find any trade setups that look very attractive, especially on the long side. The market is just, especially the tech heavy NASDAQ 100, the high growth stocks have just gone completely sideways now for many months. We're going to start out here on the 60-minute chart, and we'll take a look. I want to show you something on the weekly chart that stands out. On the 60-minute chart, I know it's busy. There's a lot of lines here on this chart, but we're just going to look at this trend line off the early March lows right there. That was broken recently after this divergent high. So we had this divergent high here that followed a smaller divergent high. The divergence extended, 12% drop. We put in a divergent high here. I figured we'd get as much or more, and so far we've gone nowhere. We're still in correction mode because we're still at where the sell signal was triggered, right a hair above it. We had this gap right here. We gapped down. I'm going to zoom in a lot, nice and tight here. We did have the divergent low here. There was a catalyst for this rally, but we put in, just like last week, here's where we left off. Well, Friday was a little bit beyond that, but we put in a divergent high there. I think that was Thursday. Yeah, that was Thursday. And as I updated today, we came at it and pretty much equaled that high, a slightly marginal new high. And I said, we could see the possibility one little thrust up, and it's still keeping that divergence in place very much. In fact, it's even a little bit nicer, more clean divergence, I like to say, because it was before we had the indicators kind of flattened out. Sometimes that's all it takes. This time around, you had that separation. See the little trough between the peaks right there in the divergence. Either way, call it what you want. It's resistance. It's the NASDAQ 100. That's about 336 right there, and down to the bottom of this trading zone is about 332. And as I said this morning, it's the same trading range as this initial bounce target zone. That wasn't much of a trading range back then when I laid it out. That was after the breakdown right here. It was a target zone because the top of that was significant resistance, and that's been resistance. It continues to be resistance. So that's it. I wish I had more to say on that. We'll just have to see how it resolves. And more times than not, much more often than not, these divergent highs do play out for tradable corrections. That still is my outlook, and we're still at the top of that range right now. Nothing really more to add to that. I'll get to the futures in a second. Just real quick on the S&P 500. It's not that I've forgotten about it. I'm just watching the NASDAQ really stall out, and that is always of concern when the market leading stocks. Remember, that's what the NASDAQ. S&P 500 has those same stocks. Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, except the NASDAQ 100, they're more heavily weighted, so we can see just how much those market leaders are lagging. And again, that's typically not good longer term, but it can go on for months, and so far that disparity or that underperformance by those leaders has gone on for months. But I wanted to point out right here, all I have to do is just add the letters. Last week, same story, nothing's changed. We had a little 60-minute divergent high right there, get a little correction on the 60-minute chart pullback, but this is just an extension of the divergences. That's all it is. So nothing has changed technically, and that's why I'm not going to spend a lot of time on the 60-minute time frame. And we pretty much have been failing right here at the recent highs. This level, whatever that is, let's say about 423. So far, that seems to be capping the advances on the SPY here, the S&P 500 ETF. And again, it also has been, when you look back, bigger picture now, trading sideways since really early April. One thing I wanted to show you, let's loop back to the Qs. If there's time, I'll get to the futures. I want to show you something here on the monthly chart. And again, this speaks to those market leaders kind of stalling out. One of the indicators, I'm going to flatten these out here real quick just to focus on this up top. This is the PPO histogram. Down below, I had the PPO line right here, but you can see when the PPO crosses over, traders use that as, sometimes outright buy and sell signals. It definitely means a change in momentum. And PPO histogram just puts shows you those crossovers in this form here, in the histogram form. So when you go from green to red, that means the PPO line down below, which I flattened out, has crossed down below the signal line, giving what we call a bearish crossover. And again, what I've done now, and I haven't talked on this one in a while, this is a monthly chart, meaning every candlestick here is a month. This goes back to the late 90s back here on the left of the chart. And so what we're encompassing are the previous two bear markets, the big ones back in 2000 to 2003 right there, really bottom in '02, late '02, and then the bear market from October of '07 to March '09, at least in the S&P. Technically speaking, the NASDAQ bottomed in late 2008. Would be right there, but the rest of everything else bottomed in March '09. And so what I'm looking at here and what these boxes are, without any exceptions, I highlighted the periods where you had on the monthly time frame bearish crossovers, bearish PPO crossovers. And so, there's the box, there it is up there, and you can see the price action. And like everything, you don't use this, or I wouldn't use it as a standalone buy and sell signal. You can, if you had, let's just say you're trading the Qs and you used a mechanical system, you can look at this, and if you're long every time these bars are green, now you have to wait to the end of the month to get a confirmed signal. It would have had you long here, long here. It would have had you long over 90% of the, well over 90% of the time the market was in an uptrend, and it would have had you out of the market or short almost, or through the majority of both the big bear markets. Now, what happens with any indicator? I haven't yet met one that's perfect. They all have their flaws or shortcomings. There are some whipsaws. So what happened is you had, you want to watch the slope of these lines. You can see it going down, looked like it was maybe heading for a cross, but it stayed green comfortably there, and then boom, had a crossover. And by the time, if you waited for the monthly signal, and this is where I'm going to say, yeah, you can see a correction there, and it's certainly decent. But by the time you got your monthly signal, most of that correction, maybe even all of it, was over. So I'm going to call that a whipsaw right there. It got you, let's say, out of your longs, but then it told you to go back in right here. Right here, again, it got you out early on in the great bear market. Don't underestimate. It doesn't look like a lot, but that's a 55% or so drop right there. And again, it got you either out of your longs or short. And then again, a couple whipsaws, if you want to call them that. This one, you got the signal, and in most cases there was a correction. If you really zeroed in, sharpened your pencil, maybe there was a little bit of a profit on a short trade, but at the very least, you got out of the longs. You didn't miss any explosive move. You maybe got back in by the time the whipsaw signal told you to get back in. And here's the thing. Here's the takeaway, guys. This is 20-something odd years, and so if you look at it that way, these two signals were golden. You just can't do any better than that, sidestepping the bear. And if you want to call these whipsaws, well, you really didn't lose anything. And even this one especially, remember, there was a almost 20% drop early on right after this signal right here. So it definitely lets you sidestep that or profit on a short. And then and sidestep this near bear, or really what we call a deer market. A deer market is in between. It's neither a bear or a bull. We went sideways for almost 2 years, over a year and a half, and so it just kept you out of there. It would have said, hey, you know what? Don't burn your eyes looking at your computer screen all day. Get out and do something else. If you're, an investor, you can be out of the market at that time, and we'll keep an eye on this every month and see where this goes. And then look, it got you back in. And then boom, big correction right there on right after that signal. You can see it doesn't look like much here. Let me turn the lines out and measure it for you. But from that high right there to that drop, if I can grab even the top of this candle here, we'll zoom in a little bit there. Right, grab the top of the candle. There it is. Got it. Snap to it. To the bottom. What does that tell me? 23.5%. Okay, so again, certainly not a whipsaw. Now, if you waited till it got green, yeah, guess what? You gave back all the profits. But that's one of the things, use this in conjunction with other things. And all I'm trying to do here is paint the big picture. We are still green on this. There's no sell signal yet. These are the things that if we break the trend lines on the industrials and the financials, which I'll get to in a second, some other things, it kind of paints a bigger picture of where we might be going, because again, I look for these hills, and you know, the whipsaws come with little hills. There's a little hill, so that whipsaw could have been avoided. You look for these big mountains, I like to say, you know, strong bull trends, and that's when you usually get whipsaw, the solid signals there. And this is a pretty big one right here. In fact, this one, the only bigger one we've had in recent years, was right there, and then that one there. So it's something to watch. And the other thing too is, if you look at this chart, let's zoom in here, turn off all the lines. This is one I've talked about on the S&P 500 and the Nasdaq 100. This 20-period exponential moving average in blue. It is just a golden level, meaning it just does a great job of defining bull and bear trends. That's the other thing. So we're right now, we're above it. When you're above it, bull market. Cross below, there was your crossover, bear market. It got you out from there to there. It was support there on that entire bull market. Doesn't look like much. That's the 03 to 07 bull. Then you cross below. And so again, using that in conjunction, you can see how these stick saves. See, these are monthly candles, and you zoom in tight, and you see how the candle went down intra-month, but then closed back above. And so this alone would have kept you out of the whipsaw if you said, okay, I'm going to use that plus the 20-month EMA. You had zero sell signals here, so no whipsaw, because every month you close on or above the 20-month. That was a whipsaw right there. You closed below it, but then boom, you recovered it the following month. So you weren't out very long. And as you can see, look at that, boom, recovery. Park that candlestick body right above it. That's a green candle. That means we closed well above it. So this is only whipsaw signal in a decade or more right there. So we're well above the 20. I just want to point that out. But that's the longer term stuff, because every time now and then I like to loop back to that. Now let me show you a couple other things, and we'll roll into just couple quick updates on trade ideas. For you futures traders, NQ, nothing's changed. Here's where we were. That was last week's divergent high. We've been diverging right here, so the divergence just continues right there. And here's our current divergence, 60-minute chart, and we're up against that 1318-ish resistance. And ES, again, I already showed you SPY and QQQ. They're going to look similar. This is ES, the S&P 500 futures, really topping it out around this level. We've been pushing on with divergence in place. So that's it. And the takeaway again is choppy but sideways market now for months, and so, you know, swing, especially trend trader, isn't going to make anything in those kind of markets. A very active trader, if you want to just play the levels, you know, you can make some money. Let's look at a few other things, and we'll wrap up the video. US dollar, really nothing's changed since last week. We were right here. We had just had this pullback on Friday. I mentioned we were in a very near-term uptrend. That's it right there. Following this breakout and back test of the primary downtrend line, divergent low. So nothing there. And as long as the dollar looks constructive, that may continue to put some pressure on gold and silver, and maybe give you a trading opportunity here on the dollar. Like I said, I'm not as keen to be aggressively short or short gold, silver, and miners, because I'm still longer-term bullish. And sometimes you can have a rising dollar, and if there's overwhelming demand for gold and silver, they either won't correct, or maybe they can either hold up and don't go down, they don't go up, or they don't go down. And at times I've seen the dollar rally and gold rally along with it when there's a really strong bid. And then that reminds me on commodities as a whole, you know, we may continue to see some pressure. This is DJP, one of many commodity, broad-based and diversified commodity ETFs that I follow, but this one I've been just highlighting recently because it's in a nice clean channel and it has a lot of everything: gold, oil, natural gas, soybeans, copper, aluminum, cattle, you name it. Bunch of well-diversified portfolio commodities. And the thing is, you just want to be aware when you hit the top of the channel, the odds that you're going to go down and visit the bottom channel increase. So we hit the top there, and we rode the top for a little while, then came down to the bottom. So basically, you want to be, you know, getting long commodities down at the bottom of the channel as an investor or trend trader, and either taking some profits, maybe even going short for a pullback trade, or at least not adding aggressively to the commodities. And again, the uptrend's strong. And everybody's different. I'm speaking more so to those that have been in commodities for a while. And even then last week, I pointed out when we hit it there, and then when we got down to this level, last week I posted several commodities such as the grains, soybeans and wheat. Had a longs on those. We had a long on copper, and we caught all those. All those hit their targets, and then some. And so we caught the bounce trade on those. So that's swing trading. But again, the commodities trade is, at least for a little while, starting to at least cool down a bit. This was a very strong advance. You want to be in these advances again. You want to be looking to go long down there, and so we'll keep an eye on those. We could run at the top. There's no guarantees we're going to go to the bottom next without hitting the top again. But again, that seems to be the MO recently, and that also meshes with the dollar. A lot of commodities are dollar sensitive, so if we do get an additional more upside in the dollar to hit those targets I'm looking at, that will likely be the catalyst to bring us down here, and then I'll be looking for re-entry points on long-term trades into those commodities, gold mining stocks, things like that. And again, they all have their individual charts, so I'm generally speaking. A quick update on AMC that has tremendous volume lately. Right now it's in the crosshair. AMC along with GameStop, GME, and BB. Those are what they call the meme stocks, or Reddit favorites. And mentioned this trend line last week. Broke, but we cracked below, but just before the close. See this breakdown? It was right before the close, and there was no volume to it. And I think I mentioned that in Friday's video. You really want to, not take breakdowns. I don't like breakouts or breakdowns that occur in the final minutes of trading, especially in the final minutes of the trading week, because then you have the 3-day weekend or 2-day week, 2 extra days overnight risk. But we jumped up today, and now we're back below it. And we've traded below it most of the day. So we're below that trend line, but I put a line here pretty much at Friday's close, give or take, about 47.33. Why is that there? Because I think that's a pretty good level. Let me turn up the volume price histogram so you can see it. Okay, the volume price histogram shows, so since this strong advance recently, since they've really started getting back into this one, you can see these bars right here. And so that line's at the bottom of these bars right here that stick out. That shows you the vast majority of traders, or a good number, have bought in at this, between this price, and they're bouncing around. They're trying to, they think the giant short squeeze is coming. They think it hasn't even begun, and they're thinking, that's what the buzz is on Reddit. They're all sticking together, calling for 200, 100, 200 or plus dollar price target, thinking the massive short squeeze is about to come. Who knows? All I can say is if they break out those, take out those recent highs, that's, you got to give it to them. That's bullish. That's resistance, and they've cleared that level, and then everybody in the stock is bullish, and their convictions will only become stronger. Why wouldn't they? Likewise, if you take out 47.33 right there, a lot of people that bought in over the last couple weeks here will be underwater. And you can see by these histogram bars, there's a thin zone. The bars stop here, and then nothing down here. That's almost comparable to, well, there is a gap there. So that's the way it works. So that would be if 47.33, give or take, goes, it should be a quick drop down to 37.63, and if that level doesn't hold, 32.22. And then you can see when you look at these histogram bars, they get smaller and smaller. There is a confluence to them right there, so there's a lot of buyers there. So that's why the top of that range is support. But then when you go below that, you've got a tremendous amount of people underwater, and that's where the stock will probably just waterfall down if and when that happens. So. All day long, Interactive Brokers had shares available to short each time I glanced at. So, there's, I don't think the stock is as heavily shorted as they suspect it is or claim it is. There's a little downtrend line too. Pop that, maybe they run. So it can go either way, and that's why you don't get married to it, whether you're long or short. But I did want to update that. I'm going to wrap the video here. I'll mention BB, BlackBerry. Mention that as a long here off $8. It's run up. And what happens with these stocks often when you go parabolic like this, the ensuing move is usually pretty sharp. to the downside. You can't say this runs over yet. Sometimes you have a little hiccup along the way, but if it falls, we're probably going to fall back here. And I mentioned this before. If you're in it, if you took it at 8 and you hadn't sold yet, I mean, first of all, congratulations. It's been a nice run from that $8 entry pointed out a few weeks back, 150% or so. But main thing is don't let it get away from you. Big support at 12.22, and if it pulls back beyond that, that's probably going to take us all the way back here to at least 960, and then maybe back to that $8 entry point or more. This is another stock where the fundamentals are abysmal, and it wouldn't surprise me at all to see this thing within a few months back down here to $6 range, if not more. GME is the other one. This one let it all off. I believe I read they report on Wednesday. Not sure if that's before or after the bell. A company like this usually before the bell, I believe, in this sector. You can look that up. There's an earnings calendar on the site. A link to that under the resources. And there's a trend line to watch right there on GameStop. So it's a quick update on the meme stocks. We're going to stop there. There's some things I'm watching in the automotive sector. The automakers, I'll probably... I have mixed feelings on that. Some of those charts look constructive, quite a few at resistance. They could be some long side trade candidates, but the big auto, your Toyota, even Tesla, GM, those aren't looking good. I'm looking for a correction there, and some of the more obscure names, many of which you hadn't heard of, those are looking a little more constructive, but I'll probably cover those in another video. This one's just gone over 20 minutes, so let's wrap it up here. I'll get it out to you guys, and again, I'm not seeing I'm not seeing a whole lot of anything that looks really compelling, on the long or short side right now. So I'll continue to do these updates, and that sometimes lasts for a while if the market's grinding around. But I'll continue to look. I'll come across a sector, some niche sector, some niche stock sooner or later that has a nice, attractive risk-reward profile and a clear, clearly bullish or clearly bearish chart. Until then, this has been Randy Finney with Right Side of the Chart. Have a great day.